Today's overlooked stock is Children's Place. Clothing business has been falling apart before our eyes on the stock chart now for about the last 2 years. We've occasionally checked in on this company. George Tsilis, senior markets correspondent, overlooked extraordinaire. But today, almost at one point, it doubled. So was this that big of an earnings report?
Well, I think on the surface, if you look at it, it was pretty promising, OJ. I mean, the expectations for Children's Place, in terms of the quarterly report, they were expected to lose $1.10 per share, which was actually a market improvement compared to the loss of $2.12 a share. So they were expected to improve their loss position, but they eked out an adjusted profit of 30 cents. So that was sort of the surprise amidst the report. But sales actually missed, coming in around $319 million, and that was down about 7.5% compared to the same quarter last year. So the sales last year, by the way, for the same quarter, about $346 million. But the whole story behind Children's Place is, essentially this turnaround story, or effectively a story where, this company can be turned around from a standpoint of activist investors. They have been. Essentially, if you look at the stock price, by the way, over the last 5 years, it's down like 92%, last 3 years, 80%. So it's been a struggling story for Children's Place, which essentially has been securing some lifelines. If you look at, just going back 6 months or so, they secured another $90 million in a credit facility. And essentially, that's helping them maintain their operations while they actually cut back on operating expenses, which if you look at this quarter, they're doing a good job in that regard, because, like I said, the losses were expected to were coming about half of where they were last year, but they actually came in quite a bit above that number. Now, if you break it also down, they did report same-store sales were down about 7.2%, and that's, again, not good considering the fact that they're closing some mostly unprofitable stores. Their cash position is very small at around $9.6 million, but they did declare that the inventories came down by about $17 million to $520 million. So over the last couple of years or so, the company has been able to secure credit lines to keep their operations going, but they're doing so in secured ways using inventories, or even in the case of the plant property equipment on the balance sheet, which is worth about $280 million. So equity, though, is around $66 million. That's your common equity. Debt on the balance sheet around $170 million, so that's quite a large number compared to the equity. But I can see why they're getting some lifelines from a credit facility, because they have significant inventory plus, assets, their plant and property and equipment, which is worth about $280 million to help sustain their business while they go through this strategic turnaround that they expect to become profitable once again in 2026.
Okay. So turning it back to profitability, which means they've avoided like the worst case outcome. So maybe this report kind of eliminated the tail risk that they're going to have to shut down or something like that.
That's exactly right. So that's why I say that the news was actually promising in terms of the gap, the adjusted profitability. They actually cut expenses significantly more than the expectations going into this print. And that's obviously the first start. Mithaq Capital is essentially an activist investor that's taken an ownership stake in common equity, but also has provided them a credit facility under the conditions of essentially restructuring their entire business. So the first thing you got to do is cut operating expenses tremendously. They're in the process of closing down the most unprofitable stores in their franchise, which again is essentially what you want to see for a turnaround story. But I do suggest that, eventually they're going to have to come to the table with a secondary, or they could certainly borrow more money, because if you just look at the news, they only have about $9.6 million in cash, where aside from the report they just gave us for the quarter, last year they lost on a GAAP basis $164 million. So I think that they're going to come in with a secondary offer in some capacity, or they're going to have to essentially get additional credit and a revolving facility to maintain operations so that they can continue as a going concern. I don't see insolvency happening, anytime soon for this company. So that's why, maybe one would be apprehensive shorting against the stock even after today's, move and double the price, just because I've seen essentially a lot worse when it comes to any franchise, let alone this retail franchise, which is struggling, but it's not struggling all that bad relative to some of the other bankrupt ones that have gone slower slip through the cracks like Bed Bath & Beyond over the last couple of years.
Ah, nice. Good comparison there. So, all right, it also seems like it's a pretty, reliable vertical within clothing, obviously, children's clothes. They keep coming back. So looks like a decent kind of turning pivot point for a stock that maybe was just kind of getting subsumed by all the different places you can, brands that you can get from this. So they've bottomed out, arguably. If things then turn south from here, that would probably be pretty concerning. This should be sort of like the kind of cleaning of the house that allows them to function more efficiently going forward now that they've shut down a bunch of stores and stuff.
Oh, exactly right. So that, like I said, this is what's happening with the underlying business. They're making a lot of, good, promising movement in that regard. But at the end of the day, your top line needs to improve. And so you have to keep that in mind. Just looking at the print, they missed on revenues, and revenues were down about 7.5% on a year-over-year basis. You could attribute that, so I'm not saying that's really bad. You could attribute some of that to store closings. So again, it's not as bad as that seems, but like I said, I suggest they're going to have to come in with some capital funding, either debt or equity or some combination, just because of the losses relative on an annualized basis to the cash position on the balance sheet.
Okay. Seems like we also shouldn't expect them to get back to their old peak market cap either, though, because they've had to cut down a good bit of volume along the way. Thanks, George. All right.